Markets feel exciting and dangerous at the same time. The only edge that lasts into 2026 is rational discipline, exactly what Warren Buffett has practiced for decades. Debt is piling up. Valuations are stretched. A handful of megacaps dominate the index. Volatility is creeping higher. If you're emotional, you'll get tossed around. If you're rational, you'll find opportunity. Let's reset how we think about investing for 2026. Not with hype, with principles that have worked for 60 years. First, remember what you are buying. You are not buying a ticker symbol. You are buying a business. Cash flows, customers, costs, and competitive advantages. If the price jumps around, the business does not instantly change. Judge the enterprise first. Price comes second. When markets run hot, people chase price. They hope to sell to the next person at a higher number. That is speculation. Investors do the opposite. They ask, what is this company worth? If price is below value, they buy. If price is above value, they wait. Second, respect your circle of competence. You don't need to know everything. You need to know your lane. If you understand an industry's economics, you can spot quality and risk. If you don't, you are guessing. Guessing works in bull markets until it doesn't. In 2026, that discipline matters even more. Artificial intelligence, chips, data centers, and platforms are powerful themes. But not every player wins. In every gold rush, a few make fortunes. Many disappear. Stay with businesses you genuinely understand, or use broad vehicles that reduce single-name risk. Third, build a margin of safety, a cushion between what you pay and what you believe the business is worth. The more uncertain the future, the larger the cushion you demand. A stable utility may require a small margin. A fast-growing but unproven company needs a big one. If broad markets reprice, even the best companies can drop. Your margin of safety helps you hold through turbulence. Fourth, minimize unnecessary activity. Imagine you had only 20 lifetime investment decisions. You would move slower. You would think deeper. You would ignore cocktail party tips and trending screenshots. Most investors don't lose because they think too hard. They lose because they trade too much. Now, let's connect these principles to today's risks and where opportunity still exists. Risk 1, leverage. More investors are borrowing to buy risk assets. Debt amplifies gains on the way up and pain on the way down. You cannot control the market. You can control your own use of leverage. Keep it low or keep it zero. Risk 2, concentration at the index level. A small group of giants carry a large share of returns. If they stumble, the index stumbles. This does not mean abandon index funds. It means set expectations. It means diversify across factors, sectors, and geographies when it fits your plan. Risk 3, stretched valuations. When price outruns fundamentals, future returns get pulled forward. That does not predict the next week. It shapes the next 5 years. A rational response is simple. Require better entry prices, add gradually, and keep cash for obvious opportunities. Risk 4, speculative behavior. Options spikes, day trading streaks, social media certainty. None of that compounds over decades. What compounds is earnings growth, purchased at sensible prices and held with patience. So what can a rational investor actually do for 2026? 1. Write your investment policy. Define your goals, time horizon, risk limits, and what you will buy. If it's not in the policy, you don't buy it. 2. Separate core from explore. Core can be low-cost broad funds you can hold through cycles. Explore is your limited basket of individual businesses. Inside your circle of competence. Size it small. Let the winners prove themselves. 3. Schedule your decisions. Automate contributions. Review positions quarterly, not hourly. Volatility is not a to-do list. 4. Hold cash by design, not by fear. A cash buffer lets you act when others can't. It also helps you sleep. 5. Focus on durable economics. Recurring revenue. Pricing power. Strong balance sheets. High returns on capital. Management that allocates capital with care. Boring often beats exciting over a decade. 6. Measure what matters. Discounted cash flows, margins, unit economics, reinvestment runway. Do not confuse a rising line on a chart with progress in the business. Finally, manage your emotions. Fear and greed are timeless. They don't disappear in 2026. They just wear new costumes. Rational investors welcome corrections. They use them to upgrade portfolios. They don't celebrate paper gains or mourn paper losses. They keep buying great businesses at reasonable prices, and they wait. That is the real edge. Not secret data. Not perfect timing. Calm process, repeated for many years. If you choose discipline over drama, you won't win every month. But you give yourself a powerful chance to win the next decade. Stay rational, stay patient, and let compounding do the heavy lifting.